Hello students, this is Viresh. You are watching Virus Academy YouTube channel. Today we are going to discuss two important concepts in the transfer pricing, that is the definitions part. Under the definitions part, one of the important definition is the definition of an international transaction as well as the deemed international transaction. These two concepts are very important because without having the knowledge of this, it is very difficult to solve the transfer pricing questions. Okay, examination questions. So that's why I'm providing this video. This video will give you clarity about what is an international transaction, what is a deemed international transaction along with an examples. So watch this video till the end, and material for this video is available in the description in the Google Drive link. So before downloading the same, I have one request to all of you: subscribe to this channel, because subscribing to this channel you will be benefited with the knowledge without any cost. Now let us start this video. Now we will see the first definition, that is definition of international transaction. This is provided in section 92B. So what is international transaction? A transaction between two associated enterprises. So if I take this example, there are two associated enterprises. One is in India and then one is in outside India. If there is a transaction between these two, then that is called an international transaction. A transaction between two associated enterprises, one is situated in India, one is situated outside India, then that is called as international transaction. Now, with this statement, can I say to qualify something as an international transaction, there should be one non-resident. One non-resident should be there. So this is the first condition. What if both of these are non-residents only? If both of these are non-resident, none of them are residents in India, then in that case, transfer pricing provisions are applicable. The answer is no. Usually, transfer pricing provisions are not applicable if the transaction is between the both are non-resident. Transaction is happening outside India. It is not taxable. Transfer pricing provisions are not applicable. But there is an exception to this rule. If any of their non-residents income is taxable in India, if any of their income is taxable in India, that non-residents, then these provisions still applicable. That is provided in the point number A. Now we will see the actual point here. A transaction between two or more associated enterprises, either one of them should be non-resident. If both are non-residents, income is taxable only in case one of the non-resident income is taxable in India. In the first case, if one is resident in India, one is non-resident, then that is called as international transaction, and transfer pricing provisions are applicable. In the first point, condition is at least one of them should be non-resident. In the second part of this sentence says that if both are non-residents, then their income is taxable, and these provisions will be applicable only in case either of the one non-resident having the income taxable in India. So this is the point number A here. When I say transaction, what are the transactions that are covered here? What are the kind of services, goods and services are covered here? A sale, that is says in the point, this next point. And these transactions are related to what? A sale, purchase, provision of services, lease, borrowing. Almost everything was covered. Lease, borrowing, anything. So at the last point they said, in the last point, any other transaction having a bearing on the profits, income, losses, or assets of such enterprise. So almost all the covered. Whatever is the income which are debited to the P&L, whatever is the income that is shown on the top line of the P&L, all were covered. If there is a bearing on the profits, then if the transaction is between associated enterprises, all of those transactions are covered here. Whether it is a good, sale, purchase, provision of services, or leasing, finance, borrowing, capital financing, anything, any kind of service were covered here. This is what the transactions are. Now we will see the last point covered under the international transaction. I will explain you with an example. There is a company called A, there is a company called B. A is in USA and B is in India. Okay. B is a subsidiary of A Limited. B is a subsidiary of A Limited. There is a association exists, so both of these are associated enterprises. In B Limited in India, there are 100 employees are there who are working only for A Limited. That means they are working on the projects, they are working on the assignments which are mostly related to the A Limited only. But they are sitting in the corporate office which is situated in India. And salaries for these 100 employees paid by the B Limited only. Salaries related to these 100 employees are paid from the B Limited pocket only. Now, for this purpose, when I say this, when you see this transaction, as these are both are subsidiaries, it's one and the same. Whether this company paid by B Limited or A Limited, it is same. But for legality, both are different legal identity. Both have different legal identity. Both entities are different. Now, A Limited should get a reimbursement. A Limited should get a reimbursement for the cost incurred by B Limited in form of salaries. Their B Limited is paying salaries to 100 employees, then B Limited will get a reimbursement from the A Limited. Whether this transaction arrangement is covered under point number C, is covered under international transaction, the answer is yes. These transactions also covered. This is the most common thing will happen in the MNCs where the head office exists in the UK because of the lesser cost in India for the manpower. What they will do is they will recruit the people from India only, but they work for the US company or UK company because the salaries are lesser in India. Okay, they work for them, but this whatever the Indian legal entity is there, they pay the salaries to these people, but they will get the funding from their head office. These funding transactions between the associated enterprise to make the salary payment or any other benefit of expenses are also covered under the international transaction. In summary, what is international transaction? International transaction is provided in section 92B. International transaction is between the resident enterprise and a non-resident associate enterprise. So one should be a non-resident. Okay, if both are non-residents, then in that case, then those transactions covered under these provisions only in case one of the non-residents' income is taxable in India. And what are the transactions covered? Sale, purchase, leasing of tangible or intangible property, provision of services, capital financing, anything, almost everything was covered, which is having a bearing on the profits. That means if it is bearing on the P&L, then those transactions were covered under these provisions. And the last point is if there is a mutual agreement or arrangement between the among the associated enterprises for the allocation of cost, benefit, or expenses, then that is also covered under the transfer pricing provisions under international transaction definition. Then you just remember the example of salaries here, MNC salaries here for the point number C. Now we'll move on to the deemed international transaction. Now, what is deemed international transaction? That is provided in section 92B subsection 2. So I will explain you with an example. So Indian companies are very smart. Indians are very smart. Do you agree with me? Yes, we all agree that. So they find out a new way to evade the taxes. Now I will give you an example. There are three companies we will take: Company A, Company B, Company C. Company B and Company C are in USA. Company A is in India, and B is a subsidiary of A Limited. A and B are associated enterprises. C is a unrelated party. Unrelated party. So, and A and B knows that there is a transfer pricing process in India, and if A sells goods to the B, then transfer pricing procedures are applicable. Then additional tax will be levied if they sold out at a lower price. So what they do is, first they don't directly sell to the B. They will approach C first. Unrelated party. For A, neither A nor B, the C is not related. So they go to the C. They will say that we will sell the goods to you, and again you sell the same goods to B. So whatever goods that are selling it to C, C will sell it to the B. So they are in this way, in this transaction arrangement, what they are doing is A is not selling to the related party. Then the international transaction definition, this transaction was not covered. So they can evade the taxes in India easily. Okay, this is the reason why they bring the deemed international transaction provisions also. Now we will see what exactly the definition is. Where in respect of a transaction entered into by an enterprise with an unrelated party is also a deemed international transaction if the following conditions are satisfied. So what are the conditions? There exists a prior agreement. Prior agreement in the sense A will have an agreement with C saying that I will sell the goods to you, you in turn sell the same goods to B in relation to the relevant transaction between the unrelated party and the associated enterprise, or where the terms are determined between the unrelated person and associated enterprise. So they will agree the terms in prior to this agreement that A will sell to the C, C will in turn sell to the B. Now, for example, is this deemed international transaction provisions are applicable only in case the C exists in the USA? For example, C doesn't exist in USA. C exists in India only. C exists in India. A sells to the goods to C and C sells to the goods to B, which is in USA. Then these deemed international transaction provisions are applicable? Answer is yes. So the status of C, where he is exactly situated at that point in time, doesn't matter. Even if situated in India or in the USA, these provisions are applicable. In summary, what is a deemed international transaction? Deemed international transaction is simply there exists a contract between a agreement between three parties. There are two associated enterprise, one unrelated party. One of the associated enterprise sell goods to the unrelated party first. Then this unrelated party will sell the same goods to the related party. There exists a prior agreement. This is called a deemed international transaction. Now we will see international transaction include. This is already covered in the international transaction definition only. So what is intangible asset was given at the down. So if you see the point number A of the international transaction includes purchase, sale, transfer, lease, or use of tangible and intangible property. So what is intangible property was given here. You can go through that. This is all about international transaction and deemed international transaction concepts. I hope you enjoyed this lecture. Okay, signing off. This is Viresh. Bye.